late 1960s, France began quietly sending ships to New York Harbor, but they weren't carrying wine or cheese. They were carrying dollars, and they wanted gold. Under the post-war Bretton Woods Agreement, the US had promised foreign governments that they could exchange their dollars for gold at $35 an ounce. For years, most countries were happy to just trust that promise, but not Charles de Gaulle. His economic advisor, Jacques Rueff, had warned him that the US was printing too many dollars and exporting inflation to the rest of the world. So France started converting its paper claims into physical bullion, tons of it, and sailing it home. In 1965, de Gaulle even gave a speech defending the move, declaring that gold does not change. It can be made into bars, ingots, or coins. It has no nationality. He knew what the dollar was becoming, and he didn't want to be left holding the bag. By 1971, this gold drain had become a flood, and Nixon panicked, closed the gold window, and defaulted on the US's promise unilaterally ending Bretton Woods. France didn't sell their gold at $35. They didn't sell it at $100 either, because they weren't trying to take profits. They were just trying to stay solvent. Now, let's be honest. If you're now asking when to sell your gold, you might be asking the wrong question. And if you're wondering whether to sell your gold just because the price has moved up, you might want to ask yourself what the French knew and whether anything's really changed since. Because the question itself assumes something that just simply isn't true, that gold is just another trade, another opportunity to take profit, another thing you need to time like a tech stock or a trendy crypto token. But gold was never about playing the game. It was about opting out of it. And the moment you try to time your exit, you've kind of forgotten why you got in there in the first place. See, gold isn't like anything else in your portfolio. It's not there to produce yield. It's not trying to outpace the S&P, and it doesn't need a quarterly earnings report to justify its existence. It doesn't do share buybacks or 10-for-1 splits. It just is. And when someone says, I think I should sell, the first question we should ask is, sell for what exactly? For pounds, the very thing being devalued every time the government adds another zero to the spending column? Or maybe for dollars, the same ones that lost more than 85% of their purchasing power in your lifetime? For stocks or bonds perhaps, or maybe real estate, all of which are still clinging to the hope that interest rates will just magically drop further, inflation will stay transitory, and no one will ever read the balance sheet. So let's be clear, you don't sell gold into something, you sell gold for something. And unless you know exactly what that is, unless you've got a purpose and not just a price tag, then selling is just a surrender dressed up as a strategy. Ask yourself, why now? Because the price has gone up? Okay, but why has it gone up? Is it because we've fixed inflation? Because the world is suddenly running budget surpluses and global trade is humming with confidence and stability? Or is it because things are breaking? Because gold doesn't go up when everything is fine. It goes up when nothing is fine. When gold crossed $1,000 during the financial crisis, that wasn't a moment of optimism. That was a siren. And when it pushed through $2,000, that wasn't about growth. It was about fear. And when it broke through $3,000 just this year, it isn't because the system is getting stronger. It's because the mask has finally slipped. And if you're watching gold rise and thinking, great, I'll lock in my gains, you kind of misunderstood what gold is doing. It's not performing, it is warning. Selling gold just because the price has gone up is like selling your home insurance because there's been an increase in break-ins in the neighborhood. There's a concept rarely mentioned on the likes of CNBC or the BBC that gold is a vote. Not for anyone, but against the system. It's the ultimate vote of no confidence. And that vote is coming in from all corners of the world. Central banks, sovereign wealth funds, private investors, insurance companies, even countries with a long history of doing things their own way. They are not buying gold because it's trending on Reddit. They're buying gold because they know that something fundamental has shifted. As one letter to the FT put it, Mr. Gold Market has voted. And he's not voting for another rate hike or a soft landing. He's voting for sovereignty. Think about who's stacking. China, Russia, India, Turkey, Iran, even though they don't report. They're not chasing a chart. They're preparing for a world where dollar dominance is no longer a given, where SWIFT isn't the only payment rail, where the US Treasury doesn't get to decide who settles its trade in and what currency. This is not about launching a new gold-backed currency tomorrow. This is about quietly building the infrastructure to make one possible later. Blockchain rails, local currency trade agreements, decentralized payment systems, secure cross-border messaging, and at the heart of all that can be a neutral reserve asset that no one can print, sanction, or freeze. And that asset is gold. And you're thinking of selling? So let's put this in historical context. Since 1999, gold has climbed over 1,100%. It's outperformed stocks, and that's not just this year, but in the last quarter century. In the 1970s, gold climbed over 2,100%. In the 2000s, 670%. And since 1971, i.e., the moment that Nixon cut the dollar's last tie to gold, it's gone up over 9,000%. There have been bear markets, but zoom out, and it's relentless, structural trend. It's not hype, not hope, just history. And meanwhile, supply is stuck in neutral, mining output pretty much flat. And since 2018, global production hasn't significantly increased, but costs are rising. Yes, new discoveries do exist, but they're becoming more expensive, more remote, more politically complex. But take a look at demand on the other side. Central banks were net sellers in 2010. Now they're net buyers in size. Over 5,000 tons added in the last decade. And the biggest accumulators, those nations that are actively seeking to diversify away from the dollar and Western financial dominance. And it's not just governments. ETFs are flowing back in after years of outflows. Chinese insurance companies are buying gold. US mutual funds may well be next. Gold isn't becoming trendy, it's becoming normal. Systematically relevant, it's institutionally being embraced, and structurally, it's becoming increasingly adopted. And you're still thinking about selling? So let's talk about psychology. Well, here's something that most investors miss. Each $1,000 rise in gold becomes easier. From 1,000 to 2,000 was a 100% move. From 2,000 to 3,000, 50%. From 9,000 to 10,000, well, that's just 11%. It's the same dollar gain, smaller percentage, which means the market doesn't need to try as hard to climb up for the next rung. And as each milestone's passed, it triggers more attention, more FOMO, more headlines, more buying. And right now, US retail and UK retail and European retail still dozing. But when they wake up, those $1,000 increments won't take years. They will take weeks. Now, none of this is to say you should never sell. Of course you should, if you have a reason. You need to fund retirement? Go for it. You're buying a house, setting up a business, supporting your family? Absolutely. You're rebalancing because gold is now half your net worth? Sensible. You're setting up a self-funded income stream using your gold savings? Brilliant. But selling just because the price looks high, that's not a strategy. That is just superstition. And here's the thing, there's just a better way. Just don't sell everything. Start using it. Reverse your dollar cost averaging. Sell an ounce a month or a fixed amount in currency terms. Gold becomes your personal reserve asset, your buffer, your self-determined liquidity. No bank needed, no redemption deal, no approval required. You're not retiring from gold, you're retiring with it. Because the smartest investors aren't those ones who sold at the top. They're the ones who never needed to sell. Gold is not there to make you rich. It's there to stop you from becoming poor. It's not a trade. It's a transfer from a world of promises to a world of reality. It doesn't yield because it doesn't need to. It's not trying to impress you. It's just trying to outlast everything else. So when should you sell your gold? When it buys you something better than itself. Not because the line on the chart looks high, because the life you want is finally in reach. And if that day never comes, even better. Because that means you've built something that doesn't bend with the system. It bends the system around you. And that's what gold was always meant to do.